Hello ladies and gentlemen, this is Usman Ali, and video is actually the third video in the sequence of the type of note receivables that we can have. So our third note receivable is interest bearing note. It is such a note receivable one which do offer an interest rate unlike the zero interest bearing note. And the second thing here in the interest bearing note is that the interest rate which is offered in the contract is different from the one which is in the market. If you remember, the first numerical was when the contract interest rate is equal to the market interest rate. It was also an interest bearing note but issued at face. Second numerical was when the contract interest rate was 0% while the market interest rate was 6%. So that's zero interest bearing. And the third one here is when the market interest rate is not equal to contract interest rate, and contract also offers an interest, actually less or more. So again, we are representing Balance Barco Company, which had made a loan to Biofoods, and they have received a note in exchange. So the life of the note is 5 years. The value or the face value is $100,000. And the note offers, according to the contract, it offers 8% interest rate. So that's the contract percentage. While if the money is lended in the market, so the interest rate, assuming that the risk level remains same, interest rate in the market is 10%, means in the market you can earn more money as compared to you are earning in the contract. 2% less. So obviously we're gonna adjust ourselves for this 2%. Okay, because we have the right to receive 10% profit. Okay, so let's solve the numerical, though that this first step of the numerical is already solved here, but we're gonna do it in detail. So let's go to the solution part and let's do step 1, step 2, and the third step of the numerical. Okay, let's do it. I have already shifted some of the data of the numerical. Our contract price as discussed was 8%, market interest rate 10%. The life of the contract is 5 years. Face value is $100,000. So based on the data, the timeline would be that we will receive 8,000 each year till 5, and we will receive the face value also. So the PMT based on that is $8,000 actually. Now our first step as usual should be to calculate the present value. Because we needed to record the note receivables actually. So to do that, we have the present value formula, and we're going to use the present value ordinary annuity formula. So it will be PMT 1 minus 1 divided by 1 plus the market interest rate power the life divided by the market interest rate plus face value divided by 1 plus the market interest rate power n. Now, how much is our PMT? Our PMT is $8,000, and the market interest rate is 8%. So that's 10% raised to the power 5, and then whole divided by the market interest rate, which is 10%. The face value of the contract is $100,000 divided by 1 plus the market interest rate 10% raised to power 5. So this would become 8,000. 1 minus 1 divided by 1.10 raised to the power 5 divided by 0.10, and $100,000 divided by 1.10 raised to the power 5. Okay, let's solve it further. So 8,000, I will take the power in this step. So 1 divided by 1.10 power 5 will actually become 1.6105 divided by 0.10. Then $100,000 divided by 1.6105. In the next step, I will divide 1 divided by 1.6105, which will become 0.6209 divided by 0.10, and 1 lakh divided by 1.6105, this will become $62,092. Now I will subtract 1 minus 0.6209 will actually become 0.3791 divided by 0.10 plus 62092. Now I will divide it. 0.3791 divided by 0.10, so we will receive 3.79, okay, plus $62,092. So 8,000 multiplied by 3.79, this would give us 30,320 plus 62092. So let's combine. It becomes $92,412. Ladies and gentlemen, I have used a 4 decimal rounded value here. There were actually more values, around 3 to 4 more decimal points were here. I did not use it, but I would request you to use it, and it will give you $92,418. Why I did not use it? Because it was like increasing the time of the numerical. It was increasing the time of the numerical, so I just decided to use the rounded values. But I encourage you to recalculate that, and you will get $92,418. Rest of the numerical will be based on $92,418. Okay, now you see here that we are supposed to pay $92,418 today, and we will receive $100,000 in the future. So we are paying less money, okay, just like the previous numerical. Why we are paying less money? It's because of this. The contract gives us less interest as well as compared to the market. So although that out of 10%, 8% is adjusted by the contract, but 2% is still adjustment is needed. For that 2%, that's why we are paying you this much less money. How much less money we are actually paying you? It's around $7,578 we are paying less actually, and that's the only reason is to adjust ourselves for this 2%. Okay, as compared to this numerical, in the previous numerical the contract was completely having 0% and it was 8% here, so we were paying even what you say deep discount. You can say that it was even steep low value we're paying, but here we are paying quite a good value but not the complete value. So that's the step number 1. Let's go to step number 2 and the step number 3 of the numerical. Step 2 is regarding the discount amortization, and it will be done if the money which is paid is different from the face value. We are paying $92,418 today and the face value is $100,000. It means that amortization table must be prepared. So let's talk about today. Today is that day when we actually pay the money. And how much money we are paying? We are paying $92,418. This is the amount that we are paying, or you can say that we are investing. In the market we have an opportunity to earn 10%, but the cash that we receive on the contract is actually 8%. You can see it's given in the numerical here also. So this discount amortization thing is actually the difference of the one you intend to earn or you have the right to earn minus the one which you are earning actually, and that's 2%. Okay, so for this 2%, that's why I am not paying $100,000. I am paying $92,418. I am not paying this $7,578 inside this $1 lakh. Okay, once we pay this money, we're gonna do an entry here. The entry is that the cash is paid. So if the cash is paid, it's a cash outflow, or a decrease in cash or decrease in asset is a credit actually. So we will credit 92,418. That's our first entry. Okay, let me shift it a little down because I need, okay. Now why we are paying money? Because we will receive, or we have received, a note receivable worth $100,000. So according to the debit and credit rules, it's not the total of the debit is not equal to total of credit. So that's kind of a little problematic with us. Okay, now what's the reason that we are paying less? Because of this 2% that we are earning less, that's why we are paying less. So how much less we are paying? We are paying actually $7,578 less. So what this thing would be, this is actually called as the discount on note receivable. Okay, now this is that money which we will earn. We have not earned it yet. We will earn in coming 5 years, and a part of it will be earned in the first year, and then another part will be earned in the second, and then in the third and fourth and fifth. So the 7,578 spreads on these 5 years, all of these 5 years, not like collectively to 1 year. So it's not my earnings. Did I receive money today of this? No, I have not received any money yet. So then what should I do with it? I'm gonna create a special purpose account, which is this discount on note receivable, and then a little portion of that will be taken from this account, and it will be adjusted to its corresponding year. Let me do the first year calculation for you, so you get the point that okay, what I mean to say here. So when this journal entry is made, upon this journal entry, a ledger will be created, and the title of the ledger would be the discount. Okay, that's my beautiful handwriting, sorry for that. Okay, so an account will be created, discount on note receivable, and on the credit side of it, we will have a credit balance of 7,578. so it's not my revenue yet, I will earn it. Okay, it's just a contra account, special purpose account for a while. So 7,578 would come on the credit side. Okay, so let's do the first year calculation, and for the remaining I will directly put the values. I hope you can do that by yourself. So in the first year, I will receive $8,000 because of this PMT, $8,000. Okay, that's my cash inflow, whereas I have the right to receive 10% interest, actually 10% of my investment. So let's calculate this one also. I will calculate 10% of the investment, which is $92,418. So this will become $9,241. So this is the amount of interest that I should have earned, or I should have received, but I only receive 8,000. How much less I received? Let's calculate that. So that's 9,241 is what I should have received. How much I receive is 8,000. It means I have received around $1,241 less. Now what should I do with this? From where I'm going to compensate myself for this $1,241? I'm going to compensate myself actually for this note receivable account that we created, actually, if you remember this one. So I will take out only that portion which is needed for year one. How much adjustment is needed for year one? $1,241. So we can say that out of this 7,578 discount, $1,241 has actually been earned now at the end of year one. Okay, so the balance of this 7,578 will decrease by $1,241, and that's the adjustment that you have to do. Now obviously this adjustment is only possible when you pass the journal entry actually. So the journal entry of this will be that you have received money, yes, $8,000. And why you have received money? Because you have earned interest. That's good. How much interest you have earned? We have earned an interest of $9,241, which was calculated here. Okay, so then this imbalance will be actually adjusted by this discount on note receivable account that is created, which means taking out $1,241 from this 7,578 and shifting it to the sorry, I shifted it to a wrong place. Sorry for that. Let me do a little bit adjustment. Okay, so it's 1241 will come here actually, and it goes like this. So that's it, we're good to go now. So we received the cash of $8,000 because we have earned interest, which is more than what we have received. So the remaining will be actually adjusted from the discount on the note receivable account actually. So I hope you got the point that how you're going to do the adjustment. Now what I will do, as you have already got the procedure from our previous numerical also, and even in this numerical year 1 calculation I have done, so I'm going to pause the video, do the remaining calculations, and then start the video and explain that to save some time and little MBs. By the way, you need to update the carrying amount, and our previous carrying amount was $92,418. With that, we will plus the amount that we have just adjusted. So this time our investment would be, after the addition, would be $93,653. Okay, and now we will earn interest on $93,653. Why? Because of that compound interest. That compound interest is that interest which is earned on your principal plus the previous interest earned actually. And as we are not receiving this 1241 interest from the contract from the biofoods, so we are actually rightful to receive an interest this time now on $93,653. So I have done the completed the table and the journal entries also. I will just explain briefly that how I did it, so you know till here. In the second year again, we will, as usual, according to the contract, we will receive $8,000. But whatever money we have invested, like this time we had invested $93,653, so we have the right to receive 10% profit on that. So the interest that we would have actually earned $9,365 if we would have invested money in the market. But we are only receiving $8,000, which means that we are receiving $1,365 less as compared to the market. So we're gonna adjust $1,365. Now from where we're gonna adjust this value? Very simple. We had a balance here, and I'm gonna adjust it like $1,365 from this ledger. Okay, so every year whatever the lesser interest that I am earning, means based on this 2%, whatever lesser interest I am earning, that's actually this 2%, and that's actually the 2%. So whatever interest lesser I'm earning, I'm gonna take it and get adjusted it from discount on note receivable. And if you remember, discount on note receivable was that money which I paid you less. Why I paid you less? Because of this, that you are paying me 2% less profit also. So that's how it works, ladies and gentlemen. The remaining rows are exactly calculated on the same manner, and whatever the adjustment is made, obviously at the end of the year it is added with the previous carrying amount to increase the investment value. You also know the journal entries. There is nothing new in the journal entry, everything remains same, all the same accounts, only the adjustment and the interest value is changing, values are changing. In the last year you will have your interest journal entry, and you will receive your cash back also. So you will receive your $100,000 back, and you're gonna finish the note receivable because the asset will decrease. So this is the overall story, ladies and gentlemen. Likewise here in the third year, in the fourth year and fifth year, you will adjust these values. Like this is the third year value, and then we have this 1652 is the fourth year value, and we have the fifth year value as 1817. So you're gonna write all these values here. At the end of the day, means at the end of the fifth year, the total of the debit side of this account will be 7,578, and the total of the credit account will also show 7,578. There won't be any difference. Okay, when there is no difference, so the ledger accounts will be closed, it will finish, and it will not be transferred to the trial balance. So that was actually the required role of discount on note receivable. So that's it, ladies and gentlemen. I hope you got the point, and then we have the Zoom sessions to clarify if there are any confusions. Stay safe, ladies and gentlemen.